The basics of real estate investment trusts, or REITs. Distribution requirements. Whether you're an individual investor or a property owner, understanding real estate investment trusts, commonly known as REITs, can offer significant tax advantages. When leveraging a REIT structure, you'll need to consider these 4 requirements and tests. Here, we're explaining distribution requirements. To maintain REIT status, a REIT must distribute at least 90% of its taxable income in a tax year. Most REITs distribute even more, often 100%, to avoid entity-level tax. The large depreciation expenses incurred by equity REITs usually don't pose an issue, as long as there's sufficient cash flow. However, if cash flow is lacking, there's a mechanism built into the tax code. Shareholders can agree to recognize income reported on tax returns, even if no actual cash distribution occurs. Form 972 is used by a shareholder who agrees to recognize a consent dividend as taxable income in the form of a dividend on the shareholder's own tax return, even though the shareholder receives no actual cash distribution of the consented amounts. To learn more about the additional requirements and tests for REITs, subscribe to our channel or visit EisnerAmper.com.